In January 2026, Canadian Prime Minister Carney paid an official visit to China. The two sides renewed a 200 billion yuan local currency swap agreement and adjusted tariffs on electric vehicles and agricultural products. Prior to this visit, a vice minister of China's Ministry of Finance met with former Canadian Prime Minister Jean Chrétien, with both sides exchanging views on promoting the development of China-Canada relations. This series of diplomatic and economic interactions occurs against a backdrop of significant shifts in the global trade and financial landscape. In recent years, the United States has frequently used the tariff tool, initiating trade frictions with multiple countries, including its allies. In response, countries like Canada have taken countermeasures. This policy uncertainty is prompting some economies to seek diversification in both trading partners and capital allocation. Against this backdrop, several trends in global capital flows are observable. Capital seeks markets with greater policy certainty. The volatility in U.S. trade policy has diminished its appeal as a safe haven. Some international capital is beginning to shift towards markets with more stable policy environments. Analysis suggests that capital is flowing to Asia, partly driven by concerns over U.S. policy credibility. Asset allocation shows a tendency towards diversification and re-anchoring. Some nations are adjusting their foreign exchange reserves and investment portfolios. For instance, certain Middle Eastern countries have increased the proportion of renminbi used for settlement and in their reserves. Concurrently, central banks in multiple countries continue to increase gold holdings, reflecting a rising preference for non-credit assets. Regional cooperation becomes an option for risk dispersion. Canada's deepening of financial and trade cooperation with China is viewed as part of its strategy to reduce dependence on any single market and diversify its exports. This type of cooperation, grounded in practical interests, serves as a case study in current international relations. These capital flow trends could have structural impacts on global financial markets. If international capital persistently reduces its singular reliance on U.S. dollar-denominated assets, the support that the U.S. stock market once enjoyed from unconditional inflows of global capital may weaken. Market volatility could consequently increase, as seen in April 2025 when the U.S. stock market experienced significant turbulence following the announcement of a new round of tariffs. In the future, asset performance across different markets will depend more heavily on the quality of their own economic growth, policy stability, and the depth of their connection to the real economy. In summary, the agreement between China and Canada is a specific diplomatic and economic event. Viewed within the broader global context, it reveals how shifts in trade policy, the demand for capital preservation, and the diversification of international cooperation are collectively influencing the global allocation of capital. This suggests that the future global financial architecture may develop in a more multipolar direction.